Following podcast was recorded on Wednesday, November 3rd, 2021, featuring Jim Bianco of Bianco Research and Ben Breitholtz of Arbor Data Science. To hear the podcast in real time, you can sign up for a free trial at arborresearch.com or biancoresearch.com or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to the latest edition of Talking Data. I'm Kristen Radosh with Arbor Research and Trading, joined today by Jim Bianco of Bianco Research and Ben Breitholtz of Arbor Data Science. Welcome to both of you. The Fed just met today and we're anxious to find out your thoughts on the taper. And Jim, can you start us off today and let us know what are the details?
Yeah, so the details on the one hand are completely expected. The Fed announced that their $120 billion of buying a month will be reduced by $15 billion a month. So they'll go to 105 and then they'll go to 90 by reducing the Treasury purchases by 10 billion a month and the mortgage purchases by 5 billion a month to get to the 15. The surprise, and it's a little bit of a surprise, is they only announced that this would be the case for November and December. So they'll go to 105 and then the 90. And then they have to meet again to decide what they want to do in January, February. And they gave us some language that suggests that the door's wide open when they get to the January meeting. If the economy's slowing, they might, stop the taper. If inflation is heating up, they might speed up the taper. So what they did was they learned the lesson of 2018. In December of 2018, when they were reducing the balance sheet, Powell famously said it would be on automatic pilot for the whole year. And the market didn't like that idea that it was fixed. So now they're saying, we're going to taper for 2 months. And then in 2 months, we're going to meet and decide what to do probably for the next 2 months after that. I guess, Ben, the big question is who will be the Fed chairman that'll make that decision in 2 months as to what they're going to do next?
Absolutely.
How about their flexible outlook? What can you tell us?
Yeah, I can comment on that quick. So there's a high degree of optionality now that's kind of introduced, and you typically think, oh my gosh, this is uncertainty. We don't know what direction the Fed's going to go, but really this is kind of comforting to the financial markets. Both on the risk asset side, you got to think that for stocks, low kind of easy financial conditions, low rates, along with the potential to have higher revenue in the event you're able to actually increase your costs, not costs, but your prices on your consumers. Also, depending on how much those costs are indeed rising on one side. So I think the Fed has kind of created this scenario where, they will be dynamic and they will be really paying attention to the econ data. And we'll see here, we have this week, we'll get a flavor for non-farm payrolls, ADP, which you can take it as you want, suggests that we should have a favorable result from non-farm payrolls. A lot of our data shows that job seeking has come back pretty strong. That should be a boon for markets as well, and maybe reinforce the idea that we could get a July rate hike. Now, for me, the kind of reaction of markets to this flexible outlook is a little peculiar, and it makes it hard to really look back and compare it to some of the events we saw in 2011, then again with the taper tantrum, and so on, in that we now have this situation that inflation itself, its momentum based, is beginning to abate, but we're getting this big inertia of rate hike expectations that somewhere around 120 basis points or so expected over the next 2 years, according to the euro-dollar curve. We're seeing that kind of globally, and that's typically what we see. But at the same time, when short-end rates rise, typically you get some kind of concern in the credit markets. You get the long end of the curve to see volatility play along, have that rise in tandem, and that's just not happening yet. So it's interesting. The Fed, Powell says, the inflation's lasting longer than expected, kind of prolonging that transitory framework or timeline. And markets aren't necessarily freaking out about that. They're still kind of, they've kind of tilted, as Jim has said, I think maybe more towards the non-transitory persistent camp, but they haven't gone the full distance yet. And that's reflected in a lot of different ways. Inflation, the five-year forward break even has come cratering down to 220 basis points from 240 basis points. The volatility further out the curve remains very muted, is not broken out like the short end. So there's a lot of things that still need to stack up here to show that, okay, investors are concerned about inflation and they really think these rate hikes are coming, and they think this is something the Fed's not going to be able to get ahead of. There's still some dominoes that need to fall.
Yeah, I'd emphasize a couple of things on that. The flexibility that the Fed had, and to some extent, the markets, it was almost like a Warshot test, because the stock market could say, "Oh, good, they're flexible, we can rally," and it seems like the bond markets said, "Oh, good, they're flexible, we could take rates higher." And everybody kind of saw into what they wanted to see into it, and the reaction was, "Tell me what the trend was in the market in the 2-3 weeks before today." And that's what you got. Rates going up, the stock market going up, commodities going up a little bit as well too. So we saw that, in terms of the reaction in the market. Now, I'll caution that in my anecdotal looking at markets, usually the big move comes the day after the Fed meeting. So we'll have to see what tomorrow is, whether or not it's an acceleration of these trends or a reversal or something else. The other thing, I think, Ben, you touched upon it a little bit here, is the Fed was almost a little contradictory in some of the statements that they made. You pointed out to me earlier today, that the Fed basically said, this is an unprecedented period that we're in, and it's really hard to forecast inflation. Okay, Jay, I'm with you. But transitory is going to end in the second or third quarter. Well, now we're getting very precise all of a sudden. Or what about the Great Resignation? Yes, this could be a completely different labor market than we've ever seen. Okay, Jay, I'm with you. But here's the reason everybody's quitting their jobs and they're getting more pay and they're doing this and that. And they're like, okay, now we're getting precise again about we don't know what's going on, but here then is a precise forecast about what's going on as well too. And it kind of left you with, Jay, is this a new era or isn't this a new era? Because you say it's hard to forecast, and then you give some definitive statements about where we're going to go. And one quick word about definitive statements. I'll remind everybody that in January is when the Fed first started using the word transitory. And that first original definition of transitory was the base effect was going to hit in April, and we were going to see inflation shoot up because April versus April, and then it was going to go away right after that. Now, all of a sudden, transitory means the second or third quarter of 2022, but it's still transitory as well. And so we'll have to see, so if we go back and we look at those first quarter forecasts and expectations about inflation, we're way beyond that. And at least give Powell credit. He admitted that. Where we are with inflation 6 months ago, 8 months ago, no one thought we would be here in terms of where we are with inflation. Now, you're right, Ben, it might be finally showing some signs of momentum slowing, but it did go a lot more than everybody thought.
Yeah, absolutely. I think the big thing here to watch going forward really is in the credit markets as well as financial conditions themselves. So as we get these rate hikes more firmly ingrained in investors' expectations, do we see this rise that's kind of typical usually? Again, financial conditions you would think would begin to tighten to a certain extent. Do we see some liquidity related situations and risks begin to arise? Do we see solvency risks begin to arise, and so on? And a lot of that has been kind of like laying in the weeds. We've had this really beautiful period for investors. That's been reflected in alternatives, things like private equity that have done so phenomenally well because leverage can be really high, rates have been really low, and there's just no real credit risk. But will that game change? And I think that's what will happen first before, for example, the stock market would ever be bothered and so on. And we all know the stock market typically does well early in a rate hike cycle. So I'd expect that to potentially be the case now, again, with the consumer continuing to spend as they say they will. But really, again, I'd be watching closely here, all these financial conditions measures, be it volatilities along the long end of the curve, credit vol, as well as liquidity and solvency. And we'll see what direction those go into year end. If they stay hunky-dory and low, boy, it's kind of like a nice situation where investors are comfortable with this optionality from the Fed, and they have the tailwind of a strong consumer and low rates. And so we'll see if that plays out that way or not. It kind of feels like that's the direction we're going. But like Jim said, let's see what the reaction is here tomorrow, and really, again, to the next number of weeks.
And the other thing to keep in mind too is the Fed didn't push back, say, as hard as Lagarde did last week at the ECB meeting about this idea. You know, they're flexible, they're understanding. When Powell was asked about the financial markets, you know, the Fed fund futures, overnight index swaps, the Eurodollar curve are pricing in of June rate hike, and then maybe a September, November rate hike, and then maybe another one in February of 23. And so we're not that far away from having 3 rate hikes priced in for all of 22. When Powell was asked about a June rate hike and maybe a couple of more in 22, he deferred. Oh, we haven't gotten to the liftoff question. He didn't say no. He didn't say no. He didn't say the market's over ahead of itself, kind of like Lagarde did last week. He just said, we haven't considered it, is basically what he hasn't said. So they're kind of leaving, you know, the door open for a lot of this stuff. So maybe, you know, the less transitory, maybe towards persistent, you know, movement of the Fed has begun, and we'll see how that plays out over the next several weeks or so too. But if that holds and we go for the next month or two, and that June rate hike is consistently priced in, and it just doesn't go away in a week or two, I think you're going to see a lot of people start moving towards that June rate hike. And then the idea that the Fed will start lifting rates in the middle of next year takes hold. We might see a different dynamic in markets, but it's still early days right now.
Yeah, and the last thing I'll say real fast is I think Powell, whoever else is there too, in the future will have a pretty hefty reaction function. That's something you're big on, Jim, too, to financial stability, to the stock market, to financial conditions, and so on. So if we do get this situation where, like you said, everything's ingrained with this June, July start to rate hikes, and credit markets start to get a little bothered, we start to see some more amplified volatility further at the curve and in equities, it'll be interesting to see how the Fed responds, because, you know, with FAIT, the whole purpose there was they're not going to respond to inflation as fast, and they're doing that for the most part. Will they have the same reaction function when it comes to financial stability? And I would venture to guess, I think like you would too, Jim, that they'll move faster than they always say they will in regards to those financial stability concerns, especially relating to the credit market. So that'll, again, another reason why I think that's a must watch.
Yeah, we saw that in 2018, January 19, and we saw that during the pandemic when the financial conditions or the markets say it's time to go, they snap to attention. But of course, the markets are not saying it's time to go. And to conclude this chat, I'll go a little bit of a tangent. Today, we're talking, it's November 3rd. We now broke the record. This would be the latest that a Fed chairman was either nominated or renominated. The old record was November 2nd. By Trump nominating Powell 4 years ago. So now Biden has taken even a longer time to do it as well. The betting markets, which again, I think are just the consensus wrapped up into one number, have Powell at around 66, 68% getting the job. So a 2 and 3% chance, or 2 and 3 chance, or 2/3 chance that he'll wind up getting renominated. But I think we're going to have to find out in the next week or two whether or not Powell is going to get renominated, because he has to go through Senate confirmation. And the Senate is an animal that, you know, they just can't figure that stuff out in a day or two. They got to schedule it out, and they have to get it all done by January 31st. And of course, they take off weeks around Thanksgiving. They take off practically a month around Christmas. So they got to get this on the calendar here real quick. So I suspect we're getting really close to finding out whether or not Powell or whoever is going to be a successor is fairly soon.
Well, thank you both for your thoughts today. Thank you, everyone, for joining us. As a reminder, Arbor Research and Trading is an institutional research and brokerage firm. Our two most prominent offerings are Bianco Research and Arbor Data Science. For any questions, please contact Gus Handler at gus.handler@arborresearch.com. Have a great day.